Shares of the enterprise software maker Salesforce are slipping nearly 4% in the after hours. In this video, we'll talk about why I think this is one of a great buy the dip opportunities that you rarely get with a company like Salesforce. We'll see year-to-date shares are down nearly 8%. Over the past 6 months, shares are still up nearly 16%. But again, over the past 1 year, you've seen a little bit of underperformance with this name. So we'll talk about their Q4 results, which came out after the market close. We'll also talk about guidance as it relates to the upcoming quarter, but also for the upcoming fiscal 2026, which is really calendar 2025 over at Salesforce. And then when we take a look at this technically, you'll see another reason for why buying the dip at this point could make sense, especially if you're planning to go long shares of Salesforce. Even maybe from a short-term swing perspective, you could look to take a crack at shares of CRM. Hey guys, hope you're doing well out there. Been about 2-3 months since we last checked in with Salesforce.com, and since then shares are down roughly about 20% from their all-time highs made just a few months ago, nearly $370 a share. And because shares have slid, so has the forward earnings multiple. On Seeking Alpha here, you see 30 times a forward earnings multiple, but keep in mind that's still for 2024 numbers. Once those are updated for 2025, that's calendar year 2025, that forward priced earnings should likely come down closer to 27 times, in my opinion. Now, Q4 numbers came out that were a mixed bag, with revenues coming in at basically $10 billion on the nose. That did miss expectations and was growth of just about 7.5%. Where you did exceed those expectations was on the bottom line, with earnings coming in at $2.78, beating estimates by roughly 17 cents. So because that headline revenue print was a bit shy of what Wall Street anticipated, that could be one of the reasons why you're seeing shares sell off in the after hours. The other reason though could be is that the revenue guidance also came in a bit lighter than what Wall Street anticipated. So Salesforce is guiding for full year revenues to come in the range of 40.5 up to, call it maybe as high as $41 billion. The estimate, or the average estimate rather, on Wall Street was closer to $41.4 billion. So Salesforce, at least at their midpoint, coming in well shy of what Wall Street anticipated, roughly about $700 million. And that would be growth of roughly 7 to 8%. Both on a year-over-year and constant currency basis. Now, they're also guiding for non-GAAP operating margin guidance roughly at 34%. So to put that into perspective just a little bit, in the most recent quarter, they did operating margins roughly 33%. So this company, you'll see as we walk through the financials, has done a very, very nice job controlling costs, allowing those operating margins to expand over the past couple of quarters. That is what you're expecting to see moving forward with Salesforce, that operating margin to kick in just a little bit more, up to 34% for fiscal 2026. On top of that, they're also guiding for cash flow growth of roughly 10 to 11%. We'll see that is a meaningful slowdown from what we saw in the most recent calendar year, but keep in mind that is still pretty solid growth, at least for the multiple and at least the free cash flow yield you're playing for this company. Now, on top of the full year of fiscal 2026 guidance, they also provide quarterly guidance. And for the current Q1 that we're in, they're guiding for revenue to come in basically at $9.76 billion. Estimates on Wall Street were closer to $9.9 billion. So again, about $200 million shy on the consensus for the upcoming revenue figure. In fact, even Salesforce's high end was basically what Wall Street anticipated on their low end side. So that could be probably the main reason why you're seeing those shares sell off in the after hours. Now, despite all of those things, I think you have to give credit over to Mark Benioff, the CEO at Salesforce, as he's done a very nice job controlling costs over at this company. A number of years ago, he was basically running a break-even business over at CRM. And since then, he's made a lot of promises on earnings calls saying that he'll right-size the business, control those costs. And well, that has certainly shown up in the numbers over the past year. That's also why you've seen shares meaningfully outperform over the past 6 months. Even over the past 5 years, you're up nicely, up 71%. So you do have to give credit over to Mark Benioff, because he said and made those tough decisions that a lot of companies out there, we took a look at Block just a few days ago, and certainly Jack Dorsey isn't making tough decisions like Mark Benioff is. Now, Salesforce is expected to cut around 1,000 jobs while also hiring for other roles, more specifically in the AI field, as they're continuing to roll out Agentforce. That is their primarily AI application. And so anytime you see job cuts, certainly is tough. We hope those people can absolutely land back on their feet. But from an investor perspective, if you're looking to invest in Salesforce, you absolutely would want to see them at least cost cut in areas where they don't need to spend, and at least hire in maybe more growing areas such as Agentforce. And back in December, they had reportedly secured roughly 1,000 paid deals for Agentforce. And in this most recent quarter, they announced nearly 3,000 paid deals have been signed for Agentforce. So that's a product over at Salesforce that they're seeing rapid growth and acceleration in the ramp up of that adoption. So good to see that. And then from their financials, things look really, really good as you have revenues grow from 9.3, call it up to basically $10 billion on the nose in the most recent quarter. For the full year, you went basically from $34.8 billion up to call it 37.9. And then in terms of the cost of revenues, that's where they've done a very good job. Basically, you see the cost of revenues actually flat on the subscription and support side, dollar for dollar, on a year-over-year basis. And then the professional and services cost of revenues ticking up just fractionally from 560, call it up to $640 million. And so what you're seeing is not just gross margin expansion, but that's also translating down to the bottom line in terms of operating profits as well. And look, for the full year, you see a very similar picture. You added about $3 billion on your total revenues, and you come down here to the gross profit. You added nearly $3 billion on the nose to your gross profit line. So very, very nice gross margins over at this company. And the problem always used to be that the operating expenses are out of control, as Mark Benioff has done a very nice job, not just controlling costs in certain areas, but also utilizing AI internally, as I believe they use Agentforce within their own company as well. And so your R&D went from about 1.3 billion, call it up to 1.42 billion. Sales and marketing flat on a year-over-year basis. So that's by far their largest expense that continues to remain flat. Again, even at a time when Agentforce still is relatively new and they have to do a fair amount of sales and marketing for it, even then you're seeing that sales and marketing expense stay relatively flat on a year-on-year basis. And then G&A went from basically 630 up to call it 770 million. They are still incurring some restructuring charges. Again, we're seeing those job cuts over at Salesforce, which again is never a good thing to see from an employee perspective, but as if you're an investor and you're going through these financials, well, then that's exactly what you want to see. Very nice operating expense control from 5.5, call it up to basically $6 billion, allowing them to grow those operating profits from 1.6 up to $1.8 billion. So again, for the full year, you're seeing meaningful expansion on your operating profits, and that is translating over at this company to net income expansion along with operating margin expansion. So all things considered, the financial statement over at Salesforce looking exactly what you would expect it to look. Very, very good progress over at this company. Now, from a balance sheet, again, things to like here are the fact that you're still sitting on about $8.8 billion worth of cash and cash equivalents. That is up about $400 million from a year ago. You are still sitting on about $5.1 billion of marketable securities, although that has ticked down on a year-on-year basis. Now, the other thing, in fact, the more important thing with this company is to come down here, take a look at the liabilities on hand. One thing you do notice is they paid off their short-term debt, which last year was about $1 billion. So they fully wiped that out. They do still have about $8.4 billion worth of long-term debt, which is flat year on year. So they didn't really pay off that long-term debt. But again, they have close to 8.8 sitting on just cash. So they're well in excess of that debt simply with the cash on their balance sheet. The other thing to note with Salesforce and really any other enterprise software company, you can take a look at Adobe as well, that fall in the same category. You have these remaining performance obligations, essentially contracts these companies sign over maybe a 1 year, even sometimes multi-year period, where they provide a service but don't really collect the revenue immediately. They sort of collect the revenue over time. That shows up in the balance sheet under the unearned revenue, sometimes as remaining performance obligations. And you see Salesforce nearly $20.7 billion of unearned revenue sitting there. So that's one thing that is counted as a liability, but not something I would necessarily consider as a pure liability, because chances are Salesforce's customers will tend to pay them down the road at one point or another. So from a balance sheet perspective, nothing to really be concerned with. In fact, was a fantastic balance sheet. And then from a cash flow perspective, again, you're seeing that net income growth from 1.4 up to $1.7 billion. And that's translating very, very nicely into operating cash flows, roughly $3.9 billion. And even when you strip out stock-based compensation of $800 million, you're still having a very good amount of operating cash flows north of $3 billion on a quarterly basis and close to $10 billion for the full year. Again, once you strip that stock-based compensation out of the picture. And now the important thing to note is that this isn't a company that's building out a lot of AI data centers to maybe rent out those costs, similar to how Microsoft is. And so you don't have huge amounts of CapEx, again, similar to what Microsoft is doing. You have just $700 million of CapEx for the full year. And so for a full year, if you take basically this $10 billion of operating cash flows, again, that's subtracting out that stock-based comp, and you get rid of about 700 million of that, you're left with about $9.2 billion of free cash flow on a trailing 12-month basis for the last fiscal year, last calendar year. And again, this company is sitting on nearly $290 billion valuation. That's close to a if I'm not wrong, 3.2% free cash flow yield, again, on a trailing 12-month basis. And that's, again, factoring in stock-based compensation. So when you factor in those numbers, it's really not that expensive, not overly overvalued from a valuation perspective, because they've done such a nice job growing those operating cash flows meaningfully year over year. Basically, any revenue growth and any operating margin growth you're seeing is translated down to those operating and free cash flows as well. So those are good things to see over at Salesforce. And then with the rest of the cash, essentially what they're doing is executing a little bit on a buyback. In the most recent quarter, they sort of put a pause on that, but over the past year, bought back nearly $7.8 billion worth of the common stock. And then they've also made the tough decision to start paying out a dividend. So over the past 1 year, $1.5 billion worth of dividends were also paid out. I fully expect this company to modestly continue to increase that dividend over the next couple of years. So Salesforce certainly has made some tough decisions over the past couple of quarters. They've also rolled out and released some very, very good products, namely Agentforce, which they are seeing really, really good adoption with. And once an enterprise begins to start using a product that they really like, they'll likely continue to use it for years and years to come, likely roll it in as part of their yearly budget. And that's what Salesforce is trying to do over at Agentforce. Only time will tell, I guess, over the couple of years, whether they can compete meaningfully against Copilot, which is Microsoft's sort of agent product out there. I think at the current time, with the small sample size that we do have, Agentforce is proving to be pretty successful. Now, you are seeing this stock sell-off, again, one of those reasons, because the guidance came in a bit lighter. You're seeing those revenue growth rates slip just a little bit, but I think all of that still has to be put into the context that this company has done a very nice job controlling costs and growing those free cash flows and operating cash flows meaningfully year over year. Now, from a technical perspective, you made your highs back here, I believe on the previous earnings report, nearly $370 a share. At that time, could be considered maybe a double top. And so since then, you've seen the sell-off. I don't think this is something to be overly concerned with. Look, if you've held shares of Salesforce and you are long this name, maybe you picked it up back here at these lows somewhere in the 200s, I think you can continue to still absolutely hold your shares. If you are a bit squeamish, you don't want to see your portfolio go into the red, you probably want to set a stop loss down here, maybe at 285, 286. You don't want to break that level, because chances are if you break that, you're coming back here in the 250s, if not lower in the 240s, because you do have some support here. Anytime you're maybe a bit worried of breaking a long-term support, you could also snap on a fixed range volume profile. That should tell you where some demand for shares would be back here in the 250s, and then lower in the 200s. You could see some support with shares of Salesforce. But look, at this point, from a technical perspective, you could also make the case shares have the ability to rebound. And so if you see some support materialize maybe in the next couple of days here, if shares sort of chop around sideways, I wouldn't blame anyone for stepping in and maybe picking up shares of Salesforce, hoping for a rebound at least to the middle of the range back here in the 350s. I think there's nothing really overly concerning about these results to the point where I'd be wanting to get out of shares of Salesforce and meaningfully send the stock lower. Certainly in the short term, the market could get spooked a little bit over the slowing revenue growth, but keep in mind they continue to expect about 7 to 8% growth over the next, call it 8-9 quarters over at Salesforce. And I think meaningfully, a lot of that will be translated down to operating cash flows and free cash flow growth, which again, for a company that's valuation still is relatively in check, could make a lot of sense. And then as more and more enterprises begin to tap into Agentforce, I think that is a secular tailwind that this company has behind itself. That was my take on shares of Salesforce Incorporated, ticker symbol CRM. Let me know your thoughts on this one in the comment section below. I think this dip over at Salesforce can absolutely be bought. Whether you agree or disagree with my take, I'd absolutely love to hear that in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.